4 reasons why Canadian stocks are better than US stocks in 2025. Welcome to the Smart Money, Dumb Money Show. I'm Keith Richards. I'm a technical analyst. I'm president of ValueTrend Wealth Management. And today we are going to talk about how the Canadian market has underperformed for the last decade versus the US market and why that has happened. But then we'll get into a number of reasons why I think that the Canadian market is actually going to beat the US market in 2025. At the end of this video, you're going to want to stick around because after I tell you why I think the Canadian market has a better opportunity than the US market presents, I'm going to give you 5 sectors that I feel are going to be the leading Canadian sectors to invest in. You'll want to wait for that one. Well, let's start with a chart that shows us how the TSX has underperformed the US market over the last decade. So here we have a comparative performance chart. And as you can see, the red line is the S&P 500. The black line is the TSX. Now, something I want you to notice is that the black line was ahead of the red line, meaning the TSX was outperforming the S&P 500 right up until around 2013, 14, 15 area. You can see that suddenly the roles reversed and the S&P moved ahead of the black line. That outperformance is seen in this diagram at the bottom, which is a comparative relative strength study. What that means in English is we're taking the S&P 500 and the TSX 300, and we're dividing the performance of the TSX 300 into the S&P 500, and the line moves up if the TSX is outperforming, and the line moves down if the TSX is underperforming in this ratio. So you can see right up until around 2012 or so, the TSX was doing pretty good. After that point, we saw that line move down, and it particularly started to arc down, as you can see right here, around 13, 14, 15. So now we're going to talk about why the TSX underperformed during this period and why I think the TSX is going to change its tune and start to outperform in 2025. Reason number 1 why I think the TSX is going to outperform, and this kind of ties into why the TSX, or at least one of the reasons why the TSX underperformed over the past 9 years or so. Well, as we know, Justin Trudeau has stepped down. Now, when Trudeau came into power, the Canadian economy was in top shape. In fact, we were amongst the leading economies in the world. Well, what happens when you tax and spend like a pirate? You end up with a very depressed economy. And we've literally, as an economy, fallen from amongst the best in the G7 and developed world to literally the bottom of the heap. We have the world's lowest productivity, the world's lowest GDP growth per capita. We have the highest debt in Canadian history. There's a lot of problems that we've seen because of an agenda that really put the kibosh on Canadian industry and, quite frankly, the middle class worker through inflation and taxation. So how do you grow an economy? You help industry create jobs, and you help the middle class worker, the average person, prosper and earn a good living in after-tax dollars. Well, that may be changing. Here's a quote from David Rosenberg, one of the leading economists in Canada, and he's saying that Canada's soon going to be led by a new leader bent on reviving business formation, developing a more reasonable fiscal and regulatory climate, and these are important. Responsible fiscal policy, wouldn't that be a nice change? And a more reasonable regulatory climate. I have a little bit of a story to tell you. So in BNN News, and you guys know that I'm a regular on BNN, and by the way, I'm on BNN this coming Monday, which is January the 13th at 12 noon. It's a market call show, which is a call-in show. You can call in and ask your questions. I do encourage you to tune in if you can. Whatever the case, BNN reported about a couple of months ago that venture capital was leaving Canada because of the new capital gains taxes that the current Liberal government is bringing in. Guess what? Money is fluid. We as citizens of Canada don't tend to move around. If you're born here, most of us will stay. But money is fluid. And case in point, our AI, artificial intelligence industry, was basically seeing a lot of the venture capital that was going to invest in Canadian AI development leave because, quite frankly, the atmosphere was not favorable to a person putting their capital in a risk situation and be rewarded with a much higher tax rate. So money's fluid. It moved down to the United States, and that's just the truth of it. As I said, BNN reported on this a couple of months ago. It was a major problem. Another case in point, I have a friend who is a venture capitalist. He works with a group of other venture capitalists, and they invest in projects all over the world. They've recently invested in a mining project. They wanted to do the mining project in Canada, found out that the red tape and the capital gains made no sense for them to do so. So they moved their explorations into other parts of the world, and they eventually opened up a multi-million dollar mine in Mongolia where the business climate was favorable and the government taxation was lower. So this sort of leads us into the hope that with a new regime coming into Canada, we will see, as Rosenberg puts it, a new product-led economic growth. So that's very positive for Canada as a backdrop, because without a good economy, that means an economy really is industry making money. Next reason why I think the TSX has got a really good chance of moving up over the next year or so. I want to compare the valuations of the TSX against the S&P 500. Now, some of you are going to say, hey, look, Keith, the US economy is literally 10 plus times larger than the Canadian economy. So it's not a fair comparison. Still, we can look at some variables and discover whether there's more opportunity in one country or the other. So we'll start off with some basics. And for those of you who aren't familiar with price to earnings ratio, I'll explain what that means. Now, again, price to earnings ratio is a little overused in my industry. It's really just one metric. It's a fairly simple metric, and it's not the be all and end all. So I'm quite aware of that. And as a technical analyst, I actually don't even look at this stuff much, but we do at ValueTrend have a CFA on staff, Craig O'Coin, and he was talking the other day about some of the reasons why the S&P, he felt, was a little ahead of itself insofar as its growth projections and how that is reflected through the PE ratio. So let's take a look. First of all, we're going to look at the TSX, and this is based on what's called forward earnings. Now, forward earnings is kind of something you need to understand, because it's really taking the street consensus, so what most brokerage firms think that the companies that comprise the TSX are going to earn, the total collective earnings, and divided by the price of the TSX itself. So to use a simple example, if the TSX was trading at 10 and the earnings came in at $1 for the collective industries, you would have a PE ratio of 10. 10 divided by 1. If the earnings were projected to be half of $1, 50 cents, you would have a PE of 20. So you then have a much more expensive market, right? So you have a market that is literally costing you $10 and you're only getting 50 cents of earnings, versus in the other scenario, you had a market costing $10 and it gave you $1 of earnings. So the higher the PE, the worse from a relative basis you have as far as a cheapness factor. Well, the TSX is projected on forward earnings, whether those forward earnings are correct or not, as coming in at 18 times. Now, according to my associate Craig, he was telling me that it's very likely that the projections are reasonable for the TSX because we don't have, the heavy-duty tech stocks and whatnot in Canada that may or may not come out faring as well as some of the analysts in the US are projecting. So that brings up the next point. The S&P has a forward PE of 21. So that by itself, using our price to earnings ratio, we understand that that is a more expensive market. Well, that may be okay if the growth is higher than the TSX. So there's another formula I could discuss, but I won't get into. It's called the PEG formula. But basically, on a comparative basis, it's more expensive in the US and Canada. But here's the crux. One of the things that Craig was noting to me is that the US is projecting 13% growth in earnings this year. Well, here's the problem with that. That was recently revised upwards. And according to my associate Craig, he feels that those projections are a little bit, shall we say, optimistic. So there's a lot of enthusiasm, let's say, built into the pricing of the US market right now, based on a very, perhaps overly optimistic outlook of pretty high growth, especially after 2 years of solid growth and coming into an environment where the Fed has recently said, hey, we might have to raise interest rates a little bit, at least stop with the easing. And that is not good for technology, which has been the leading industry in the US. So that brings up another factor as to why I think the TSX is cheap. And that is that some of our major components of the TSX are oil and gas and materials. All right. So let's take a look at some of these major companies. Suncor Energy, which I will disclose ValueTrend has a position in, and Canadian Natural Resources. Both of these are energy companies and they're trading at 12 times earnings. That's pretty cheap. Well, Hudbay Minerals. Now, not all the materials are cheap, but there are a lot of these materials that are dirt cheap. And Hudbay, which is a very, very well-run company, very respected company in the materials, metals, and mining industry, trading at less than 10 times earnings. That looks like a fundamental bargain if there ever was one. Now, let's do another couple of comparables. Royal Bank, all right, big Canadian bank. 30% of the Canadian index is based on financials, and banks are a big part of that. Royal Bank trades at 13.5 times forward earnings. Well, let's do a comparable. One of the biggest banks in the US is Bank America, BAC. It's trading at 16 times. Okay, so yes, you could argue bigger market, bigger growth potential, or maybe not if, in fact, the Fed doesn't cooperate in the US, where we know in Canada that the Canadian Fed is being forced, because of Trudeau's policies and the depressed economy we're in, they're being forced to reduce interest rates. And that only helps the banks, because the lower the rates, it does tend to help them get more loans and whatnot. So I'm just saying, on a comparative basis, some of the sectors on the Canadian economy are dirt cheap. Let's take one last look at the major sectors in the US market, the Mag 7. The Mag 7 as a group, which includes Tesla and Google and Microsoft and Nvidia, etc., these guys have an overall PE of 35 times. So we use that example again, $10 for $1 earnings. You're paying $35 for the Mag 7 for every dollar in earnings. That's rich, okay? Now, poster boy for the Mag 7 is Nvidia, and we're seeing, brace yourself, 55 times earnings. Boy, there's a lot of enthusiasm built into that stock. One more metric when we look at the value of the US market. I just talked about how forward earnings on the S&P 500 versus the TSX, it was cheaper on the TSX. The problem, as I said, with the forward earnings projections for the S&P 500 is, according to Craig here at ValueTrend, they may be a little bit optimistic. Well, the best way to remove that bias by the street, and by the way, Wall Street tends to have an optimistic bias on earnings. So if we want to remove that optimism and just look at the facts, as I think it was Colombo said, just the facts, ma'am. Well, we're going to look at just the facts here. And we're going to look at what's called the trailing PE ratio. That means what the earnings actually have been, not what we think they're going to be, because what we think they're going to be could be a complete fantasy. But what we do know is what just happened, and we know what earnings are. So the trailing PE ratio is the actual PE ratio as it stands right now. Now we're going to look at another metric for the S&P 500 that suggests that the S&P 500 is becoming quite overvalued. I'm now going to show you a trailing PE ratio. Now, trailing is different from the forward earnings. Remember, we just looked at forward earnings, and what that means is we're projecting what earnings might be. Well, that's just a projection. Reality is that those projections could be completely wrong. And Wall Street does have a little bit of a reputation for being overly optimistic with earnings, as some of you may be aware. I always tell people, don't trust the media and don't trust Wall Street because they got something to sell you. Both of them do. Now, I'm an analyst. I have nothing to sell. What I have is to try to make money for my clients, and that's all that I am interested in. I'm interested in reality. So when we look at this chart goes way back to something like 1900. And you can see that right up until about the year 2000 or so, that the S&P 500 would have a trailing or up to the moment PE ratio based on earnings that just happened of around 25 before it became considered overvalued. And the market would fall after the PE ratio reached somewhere around 25. And this carried on for the better part of 100 years, where you can see that 1929 even, which was the greatest crash the market has ever seen, the PE got around 25. In 1974, it didn't quite hit that, but again, that was a time when the market went absolutely sideways, and there was a major peak around 1,000 on the Dow, for example, that was never cracked again for another 17 years, and that was when the PE got very close to 25, I think at around 20 that year. Well, here's the year 2000. Everybody remembers the tech bubble. Just before the tech bubble imploded, the market hit 35. So this brought in a new era. In fact, it hit 35 and it went on to get much higher, closer to 45 times earnings. So the new era, as far as I'm concerned, was no longer the 25 PE trailing was overbought or overvalued, but it seemed to move into the 35 plus zone. So as soon as we get into that 35 plus, we saw market corrections, 2000, 2008, 2020. All of those occurrences, yes, you could write it off according to reasons behind, such as the tech bubble or COVID or whatnot, but all of these instances saw a market retraction in a pretty big way after a period of high market valuations. So what I want to show you now, if I erase all my stuff, is that currently the trailing PE ratio is at around 30. All right. In fact, it's almost precisely 30 as I speak at the beginning of January. So yes, there's potential room for the S&P to go a bit higher and become a little bit more overvalued. But you'll notice that when it gets around that 35 level or higher, you're definitely looking at a very serious situation for the markets. And one could most certainly argue, no matter what the case, that we are not at the lower end of the range when it comes to PE ratios. We are looking at the high end of the range right now. Okay, next argument as to why I think that the S&P 500 has less upside, and therefore the stocks within the S&P 500 have less upside than the TSX. So let's take a look at the Mag 7s. Now, the Mag 7, Magnificent 7 stocks are stocks like NVIDIA and Microsoft and Tesla and companies like that. You're probably aware of them, Meta. They're companies that have literally driven the market. And as we talked about earlier, they've seen the lion's share of the growth on the market in 2024 and 23. In fact, 35% of the S&P 500 is in those 7 stocks. Now think of it, 500 plus stocks, 7 stocks are doing 35% of the lifting. We're kind of looking at a pretty concentrated group that we're relying on. And in fact, in 24, the group on the whole had about a 67% return. Well, is that repeatable year after year? I don't think so. You may disagree, but I've been in this business for 35 years, and I've never seen anything consistently make that kind of return. And in fact, if we look at the chart here of the Mag 7, so this is an ETF called MAGS. as you can see at the top here. MAGS has been moving in an uptrend. So the MAG 7 have been in an uptrend. We're going back to about 23 here. And you can see that whenever the market arcs off of that trend line, it tends to retract for those stocks. It happens over and over. And this is a very typical pattern in any trending market. So there's no doubt about it. Before anybody says, oh, I think the future is the MAG 7. I agree, the future is MAG 7. At least it looks that way for now. But we can also argue that whenever this market, these group of 7 stocks get too high, the market gets too exuberant and maybe rewards them with a 65% return in a year, then we're probably due for some sort of correction. And that's where we are right now. The market tends to return to that trend line over and over, and look where we are right now, and look what's happening lately. If we zoom in on the market, you can see that the MAG 7 stocks are clustering. They're basing after a big rally. Well, guess what? It clustered here. It's clustered here. When you get a cluster, often you will see a return to the trend line. Now, the other thing you could see happen is that you could see that the cluster continues. So if I raise my line here a little bit, you can see that the cluster could continue and the trend line meets. Either way, you've got a period of relatively benign performance compared to previous years. It's called regression to the mean. Nothing lasts forever. The other things I'm going to show you on this chart are the indicators, momentum indicators like MACD and RSI have rolled over. And you can see in the past where they have rolled over, there were big moves. And as in this case, RSI moved to the bottom of the trend or bottom of its range, and RSI is probably on its way to the bottom on its range. MACD, when it crossed and rolled over, it fell quite a bit. And we're just at the start of MACD rolling over for this group right now. So my thoughts are that if you are considering the S&P 500 and its potential, you have to take into context that the 7 stocks that are vastly overweight part of that index may be due for a prolonged period of sideways or perhaps even negative movement before that trend continues. At the beginning of this video, I promised you I would tell you the 5 market performers that I think are going to do best in Canada. Well, here they are. What I'm looking at are the 5 worst performing sectors from 2024 and projecting them as to potential sectors that will turn around and literally rotation of the guard type of thing become the best performers in 2025. Now, if any of you are familiar with what's called dogs of the Dow, this is a practice that's been going on for many years where investors will choose the worst performing stocks on the Dow Jones Industrial Average every year. At the beginning of the year, they buy the very worst performers from the previous year. And more often than not, those performers that were the dog's breakfast just last year turn into some of the best performing stocks the following year. So sector rotation is part of that theory, where the worst performing sectors can become the best performing sectors after a bad year. And sometimes the best performing sectors reverse and become some of the worst performing sectors. If you buy into my argument, like I just showed you on the MAG 7 chart, you could maybe agree with that the MAG 7s might kind of go sideways or at least not have such a exuberant return in 2025. And we should be looking at undervalued sectors. So these are the sectors that I like: materials, utilities, energy, staples, and financials, insofar as sectors that have the most potential for doing a turnaround in 2025. Now, I'm going to focus on 3 or 4 of them, and that is that materials, which make up 14% of the TSX, are very much, I think, in a technical position to move. I like energy a lot. Again, another 13.5% of the TSX. And then finally, if you take the other 2, there's about 4 to 4.5% in each of those. If you add these 4 sectors up, you have about 36%. So 36% of the TSX is made up of some of the losing sectors in the overall North American markets in 24. Well, there's a pretty good chance, and if you link below, you will see my videos on energy that I've talked about this as a possible trade in 25. I'm quite bullish on energy for the year 2025, as I am for materials. Now, what's interesting is that if these sectors, which represent more than a third of the TSX, do well in 25, then the banks, the financials, which represent 30% of the market, so now we're closer to 35, 36% of the index, we're talking 2/3 of the TSX, well, the banks will do better because they service these companies. Think of it. Banks give loans. Insurance companies insure projects. These companies will benefit when we get rid of the government that has been kiboshing the materials and energy sectors through oppressive policies, and we open up the doors to them to expand, and people like my friend don't have to go to Mongolia anymore to open up a mine, and they can invest right here in Canada. Well, you've got banks, you've got insurance companies that will benefit from this new agenda where our main industries can prosper. So the banks only benefit from that, and they're 30% of the index, so everybody wins when these guys win. And I think there's going to be some major rotation from last year's underperformers to this year's outperformers. So I hope this video gave you some ideas on what could happen in 2025. I'm actually quite convinced that you're going to see a real rotation of the guard in 25. And I really am quite convinced that Canada, after a period of so many years, 8, 9, 10 years of underperformance, is going to see a massive change in that performance. I really do think that the opportunities are there. You have to do your diligence. You have to study the companies you're looking at and the sectors you're looking at it. Don't just take my word for it. But this should be food for thought and ideas that could help you prosper in your portfolio in 2025. The objective of these videos is to provide you with ideas to help you come up with new strategies for your own personal investing. And by the way, if you don't want to invest on your own, ValueTrend is in that business. We're portfolio managers and we're good at it. I've been doing it for 35 years and our performance is on our website. Take a visit. Thanks for watching and hope to see you next time.